Welcome to a new episode of Sustainability Forward, our podcast, where we discuss the pertinent issues of sustainability as it affects our lives and the lives of the inhabitants of our planet. In this sort of mini series that we have been doing in terms of episodes, we've been talking about climate economics, climate finance. And today we have a special episode dedicated to climate finance, and we have a very special guest to help us understand these issues on today's episode. As always, with me is my co-host Carmine. Carmine, would you please introduce our guest speaker?
Thank you, Wrishi. Yes, today I'm very pleased and really excited to welcome to the show Professor Nuno Fernandes. Nuno is a finance and governance expert, speaker, author, and consultant. He's also professor of finance at the IESE Business School, not executive director, and member of audit committee at the European Investment Bank, research associate of the European Corporate Governance Institute, and managing partner at Otber Batson Board Solution, where he focuses on helping boards establish and maintain strong corporate governance. His particular areas of interest are corporate finance, sustainable finance, corporate governance, mergers and acquisitions, banking, and financial strategies. From 2018 to 2023, he was the chairman of the Board of Auditors at the Portuguese Central Bank, Banco de Portugal. In the past, Professor Fernandes was professor of finance at MD in Switzerland and Dean of Católica at Lisbon. A regular contributor to international media, including the Financial Times, Forbes, and the Wall Street Journal. Professor Fernandes is the author of several books, including Finance for Executive, A Practical Guide for Managers, now at the second edition, The Value Killers, How Mergers and Acquisition Cost Company Billions, and How to Prevent It, and Climate Finance, that is the book we will talk about today. He also received numerous teaching and research awards. He has been published in leading international academic journals. Professor Fernandes earned his PhD in Management of Finance from IESE Business School and a degree in Economics from the Universidade Católica Portuguese. Nuno, I'm so excited to have you here. Welcome to the show.
Thank you very much, Carmine and Wrishi, for the invitation. I'm very happy to be here with you today. Thank you.
Thank you so much, Nuno. And actually, let's start from climate finance, from this book. It's very pertinent to our podcast. Let's start from there. So could you help to explain the core premise of your book and what motivated you to focus on climate finance?
Very well, thank you for the question. So so I'll start with the end. What motivated me, and then I'll share some ideas on the book and the core premises. When I started writing this book, which was in 2020 or 4 years ago exactly today, basically I was motivated 3 reasons. First, there was lots of interest and questions coming from alumni, my clients, top executives around the world, executive education participants asking me questions on this topic of climate and finance and sustainability and finance more in general. Then my own professional work as a professor, I'm a finance professor, and finance is all about risks and returns. And so this is very much core to my work and my speciality. Then in my board work, I'm a member, as you mentioned, of the board of the European Investment Bank. And the European Investment Bank has labeled itself several years ago as the EU Climate Bank. So as a board member, I became much more involved in this topic over time, also from a practical point of view. So these 3 things basically motivated me to study what is really the impact of climate in finance and finance on climate. They're the title, Climate Finance. Ultimately, the core premise of the book is that there is a 2-way street. Climate impacts finance, meaning climate change impacts finance and financial markets, but also finance and financial decisions also impact future climate change that we will see. So it's a 2-way street, as I usually say. And so that's one of the core premises of the book. But the book is really about helping managers to think and make you think, give you frameworks to help you in decision making and see how finance can help in that decision making. I try to write a balanced book, and several of the reviewers that reviewed the book and several of the endorsers said, actually, this is a very balanced and not unidirectional book. Because indeed there are some areas in which there are gray areas. It's not everything is black or white. What I try to do is bring academic rigor to the discussion in all topics. I try to find what's the most important research, the published research on the topic. I have more than 450 papers that are used in the book at some stage, and try to make it as applied and practical as ever, grounded in reality, with lots of case studies from companies, almost 100 mini case studies, lots of data, lots of interviews with executives. So these three things, try to be balanced, at the same time rigorous and practical, I would say, are some of the fundamental points of the book that I try to bring.
And by the way, I appreciate that. As I've been a student of corporate finance for Nuno, I just echoed this kind of approach. I mean, and having read the book, I can confirm this approach of really being rigorous, as you said, focusing on what finance is, and again, our risk and returns, and also very accessible and very practical, looking at business case on real example of real life. So I want to confirm and echo what you said.
Thank you, Carmine. Thank you so much for that.
There you go. That's a hint to our audiences also to have a look at the book and enjoy some quality time reading about climate finance. Now,
and
by
the way, let me say one thing. If you have the book and you take pictures of the book in interesting locations, send them to me and I post them on my social networks. I have people taking photos with the book in very interesting locations, in front of the Taj Mahal, in the Mount Fuji, the Egyptian pyramids. So if you have any interesting locations where you take photos of the book, send them to me. I collect those.
Actually, on that point, Nuno, please state for us the name of the book and how our audience can find it at this point.
The book is called Climate Finance, and it's available in many bookstores around the world, and of course in leading online bookstores like Amazon and others.
Okay, excellent. So Nuno, now in the book, what do you think are the sort of major challenges and opportunities with climate finance that you've highlighted, especially considering the financial risks and rewards of transitioning into a sustainable economy?
Right. So, I mean, I think thank you, Wrishi, for the question, which is a very broad one. I mean, that's basically a question that takes more than half of the book. I'm going to try to summarize it here for our listeners. I mean, finance ultimately is about linking capital. It's about linking demand and supply for capital. And investors, the supply of capital, they care about risk and returns. And why do they care about climate? And why is this topic important for investors? It's very simple. It's because climate changes bring new risks to investors. And so they fear, in particular, long-term investors, they fear that the long-term returns on their portfolios may be in danger. And also, there are shifts in society's views and preferences. We see consumers, we see employees, we see many stakeholders more involved and engaged in topics related to sustainability and with preferences, showing with their preferences. On the other hand, what we do inside companies and investment vehicles and banks and other financial market participants, what we do there also has impact into future climate evolutions. I mean, for instance, to comply with the Paris Agreement, we are going to need trillions of dollars of private investment. And so public investment is not enough. And so we need banks and investors to enable that transition. So that's a fundamental point to remember, is that this is not going to be done with public capital. And so if it is not done with public capital, we're talking about private capital. It's all about risks and returns. And investors, coming back to investors, the price that they're willing to pay for different assets is changing because they see the risks and they incorporate the risks in their decision making. And we see this happening with all kinds of investors, from private equity investors to pension funds, to active asset managers, to sovereign wealth funds, to endowments, family offices. All of them are trying different strategies to basically balance this, as I said, the risks and returns. Moving to the corporate and the question on the transition. The corporate side is one of the important points is risk management and managing your risks, as always. And here we have additional risks that have to be managed. Then finance is there also in corporate to help taking decisions and rational decisions based on quantitative analysis. And so bringing some rational decision-making, some rational analysis can help in decision-making. And this can be done at multiple levels, from the company standpoint, from the whole supply chain standpoint. And many companies, what they're doing is seeing finance and sustainable finance field in general and incorporating into their business models, incorporating into their finance conditions, and making this a source of competitive advantage for companies. That's one of the things I try to highlight. Now, at the same time, we also have to be mindful that there are several cases of pure greenwashing out there. I mean, just for the fact that you label yourself green or say that you're sustainable doesn't really mean you are sustainable. So at the same time, we have to be mindful of the fact that in the corporate sector, in the financial markets, and also globally, there are some examples of greenwashing going around, and we have to try to mitigate them and reduce them because they impact the whole credibility of markets overall.
Thank you, Nuno. Very clear.
Now, actually, listening to you, Nuno, so you're talking about risk and how they're connected to performance. So, in this case, in this kind of dynamic, so would the buy low, sell high, that is kind of basis for investors, will apply in this case? Because it looks like there is still a debate on whether the ESG investment pays off for investors, or we need to think differently with this on climate finance.
Great question, Carmine, and glad to see that you remember some of the core principles in our corporate finance course in the MBA at IMD from several years ago. Good. I mean, so we have to understand that that's a fundamental principle of investment, of course, but even more fundamental is the principle of the relationship of risk and returns. I mean, that's the core, one of the core finance principles. Several Nobel Prize winners were granted to people that modeled this. And so what we know is that higher risk should be associated with higher return. And so things that are risky, we only invest in risky things if they give us a higher return. And then we invest in safe things, expecting and accepting to take a lower return. But why do we take a lower return? Because they're safer. So there are several ways to answer that question. First is that there's lots of good evidence on the corporate benefits of incorporating climate into decision-making, into risk management, into strategy, into finance, if you do it well. On the other hand, it's also important to understand that if companies that have, and you mentioned ratings, for instance, I mean, ESG ratings is a way to assess investment. I mean, or funds that invest in ESG. If you have a fund that really invests in, let's say, good ESG companies, which means more sustainable companies, or speaking about climate, just on climate, there are typically two climate risks, what we call the physical risk and the transition risk. So if, without going deep into this, I mean, these are the two core risks in terms of climate. And so if there are funds, and there are several, that invest in stocks that are better prepared for the transition, and so have lower transition risks. Now, those funds that invest in lower transition risks companies, those funds inherent have lower risk. So if they have lower risk, we should expect them to have lower returns. And it's really funny why some people expect that high ESG funds or funds with good sustainability practices, which means lower risk, why should they have higher returns? It's like saying German bonds are the bonds that should give you higher returns around the world, not Venezuelan bonds. It's obviously not true. German bonds, they get very low returns. Why? Because they are low risk. The same thing happens with ESG investment. If high ESG rated companies or funds, in general, they're seen as lower risk, and so lower risk means lower returns. So that's a fundamental thing that many people forget, is this link between risk and return. Now, in the short term, there may be a transition moment in which there is an increase in value for high ESG investments. But that's only a transition period. And in the medium long term, we should not expect higher return for lower risk. That makes no sense.
Great. Nuno, you just briefly touched on ESG for a second, and I wanted to ask that question. And something that you've explained well in the book, but for our audiences, can you give us your, or maybe a quick summary of ESG ratings, but more importantly, what do you think are the benefits and challenges of ESG ratings, and how can companies position themselves by utilizing these ratings?
Thank you, Wrishi, for, it's a great question, and it's a very topical thing, the ESG ratings and how to use them and what to do with them. First, I would like to say ESG ratings, they are metrics that try to measure companies' performance on ESG, environment, social, and governance issues. Now, ESG, it starts with the fact that we have 3 letters. So when you look at ESG ratings, some may give more weight to the E, some may give more weight to the S, some may give more weight to the G. So they're not all constructed equally from the beginning, because different rating companies, they say, we focus more on G, we focus more on S, or we focus more on E. That's a fundamental thing, which is their difference by construction. Okay, in the beginning, and they're very transparent about this. The builders of these ratings, companies that build these ratings, they're very transparent in saying what they do. Now, so what are ESG ratings? They are basically ratings that aggregate a number of indicators into a score that measures the firm's ESG performance. And what do we do with them? Well, we can use them in many different ways. We can use them to include in valuation models, to create portfolio ratings, to help investors make investment decisions, to create indices. There are actually indices of ESG that ultimately can be used to track performance of stock markets on high ESG companies. And finally, they can help companies guide their changes in their operations and their business models to become more sustainable over time. Now, how are they constructed? I already said some. It's a combination of many different metrics. So in the end, what you find is that different rating companies construct ESG ratings, and they vary from provider to provider because, as I said, they have different focuses and different coverage areas. And investors that use these indices, they have to understand what these indices are for and make sure they actually fit the purpose of what they're trying to do. So that's the first thing I want to say about ESG ratings. They are valuable pieces of information that help us in decision making. Then I also want to stress that they vary. Okay, as opposed to the bond ratings that we are familiar for the last 100 years, we have Moody's and S&P, for instance, giving bond ratings to companies. And so a company that has its corporate credit bond rating A in the Moody's scale is also going to have an A on the Standard & Poor's scale. A AAA company is a AAA for both rating agencies. And that's true in the bond market, that's true in the credit market, because what we're ultimately talking about is, will I get my money back as a bondholder? And the way to address that, it's very simple and it's modeled for decades. So ratings are the same when we look at corporate bonds. ESG ratings, they're not all the same. And some people look at this and say, oh, terrible. They're not all equal, they're terrible, they're garbage. No, that's totally wrong. It's great that they're not equal because fundamentally they were created differently. As I said, some give more weight to one thing, some give more weight to another thing. Even within the E, when we talk about the environment, there are lots of dimensions in which we can evaluate companies' performance on the E. We can look at carbon emissions, we can look at transition strategies, we can look at waste disposals, water consumption, biodiversity. There are lots of different sub-criteria within the E. And again, different rating providers give more weight to one criteria than to another criteria. So what do you think happens as a result? You're going to have different ESG ratings for the same company, just because they assess different things. So if they assess different things, they focus on different things, it's obvious you're going to get different results. Are they useful? Very useful if you know what you're doing with them and if you understand what they are actually doing and computing. I hope I've answered your question.
No, you have. I mean, it's a great tool, but as with everything else, garbage in is garbage out. But if we know how to handle the system, it can be quite beneficial, is what I concluded. Thank you.
Indeed.
Now, Nuno, based on your research on company and monitoring the performance on this kind of companies that are now publishing their ESG ratings, etc. So I saw also there are multiple, and it's not so easy to look at them. But is it true that companies that do well can do well by doing good? There is a relation there, a correlation, or it depends?
I mean, I guess it depends on what does it mean to do well, right? I mean, yes, but that's the answer to your question. So yes, but there's also a lot of greenwashing, as I said before. So the doing well and doing good at the same time happens, okay? But happens when you do things that are actually material to your business. If you have actually serious sustainability KPIs, if you're serious about that, you have serious KPIs, serious targets. And if you have well thought about the business case, and you have thought about the business case through, and then translate into the financials. So yes, it's true. There's significant evidence, research evidence showing that it is true that companies that do good, they also can do well. So it doesn't necessarily cost you, but you have to do it properly. Okay? That's the short answer to your long question and topic.
No, excellent. That is a good way to summarize what is, of course, a very very involved and intricate question. No, this has been quite an enlightening conversation for Carmine and I think it will be very useful for our audience as well. I like most of us, we think about climate finance in different ways, sometimes with strong understanding, sometimes with not so much. But the topics that you've highlighted today, especially, the challenges and opportunities in climate finance, that's been quite an important topic for us. The question we had around ESG ratings, I think that also gave us a good framework, that we could utilize, to use ESG ratings or to not use them when they're not relevant. So, so at this point, all I can do is thank you for participating in this podcast. Our aim is to demystify some of these topics for our audience base, which is quite wide and varied. So your participation in this podcast today has been very, very useful, and I'm sure our audience will love this episode. Thank you, Nuno.
Thank you very much, Wrishi, and thank you very much, Carmine, for this invitation, for the great questions and the way you led this very interesting conversation. And to all our audience, thank you for listening. And I would love to hear about cases you have on this topic or any kind of interesting ideas or support that you may have on this field. I'm always eager to help. Okay, thank you.
Thank you so much, Nuno. And thank you, everybody.
Thank you.